Hi there, welcome to the Open right here on BNN Bloomberg. Let's get to those big stories we're bringing you from our newsroom. The U.S. ambassador to Canada says this country and the U.S. have a chance to reach an agreement to cut tariffs despite last month's diplomatic blow-up. The ambassador, Pete Hoekstra, told a conference in Ottawa that the talks will resume, but he's not sure when. U.S. President Donald Trump halted negotiations in October after Ontario Premier Doug Ford ran an anti-tariff ad featuring former U.S. President Ronald Reagan. Extendicare is buying a company called CBI Home Health for $570 million. The acquisition expands Extendicare's geographic footprint and establishes a bigger presence in the Alberta market. It will also boost its care models, including service partnerships with hospitals and specialized community services. Shares in NVIDIA now slipping in the pre-market. Now, the company delivered a strong revenue forecast. For some investors, it pushed back on fears that the AI industry is in a bubble. The world's most valuable company does expect sales of about $65 billion US. About $3 billion more than analysts predicted. Let me correct what I just said. NVIDIA actually higher than 5% or so in the pre-market. We had a glitch there on our graphic. And U.S. futures, you can see pointing up, investors encouraged by the results and commentary from NVIDIA. Near record highs, but you can see it's been in that pretty flat range for quite a few weeks now. Let's have a look at oil, crude prices. Marginally stronger today. Often crude trades in the short term in tandem with stock prices. And let's have a look at gold. Gold pretty flat today, barely above that $4,000 psychological mark. And let's have a look at the Canadian dollar. And the loonie trading right now on an expectation that the Bank of Canada is in no hurry to cut interest rates once again. And finally, let's have a look at Bitcoin. Bitcoin has been suffering lately amid anxieties over tech stocks. It's holding its own today. Investors happy with NVIDIA's third quarter results. We did see the chip giant shares trending higher ahead of the bell. Revenue in the latest quarter stronger than expected, easing concerns for some about an AI bubble. Let's bring in Gil Luria, head of technology research at D.A. Davidson. Thanks very much indeed for joining us. What jumped out for you, please, in the latest quarter?
So not only were their results great, they're still exceeding expectations in spite of the fact that the numbers are now out of this world. They exceeded expectations for next quarter. Next quarter, they're going to do $65 billion of revenue. This is a company that was doing that much in a year just a couple of years ago. So that's impressive in itself. But what's a lot more important is that the company followed through on longer-term guidance, on saying that they're going to sell $500 billion of the Blackwell and Rubin families between this year and next year. This is the first time, the last couple of weeks have been the first time they've provided long-term guidance since the AI cycle started. So that tells us that they're more confident now than they've been over the last couple of years. And that's saying something, especially since that number is a lot higher than we expected. We're now talking about them growing to over $300 billion of revenue next year from something closer to $200 billion this year. That's the incremental $100 billion of revenue is absolutely staggering. And they really provided guidance for that for the first time.
So just give us that again. They're talking about next year, potentially revenue hitting $1/3 trillion, up from 200 billion this year.
That's right. That's right. It's unprecedented rate. No company has ever added that much revenue in a year. No other company's ever added as much revenue as they're adding this year ever. And then the number they're going to add next year is even more. And it's at a very high profitable level. They're doing this at mid-70s gross margins, and they can't spend money fast enough for that not to go to the bottom line. So they're generating tremendous amounts of cash flow, which they're still using to buy back stock. The stock isn't even expensive. It's now, because we raised our numbers so much, it's trading at 27 times next year's earnings. To put that in perspective, that makes them the least expensive part of the AI trade. NVIDIA, which captures most of the profits, almost all of the profits at this point from AI, is trading at the lowest multiple of any of the parts of the AI trade.
The Wall Street Journal says today that the law of large numbers hasn't seemed to catch up to NVIDIA yet with this frenetic growth.
Yeah, and I think people have been waiting for it to kick in, and clearly it is not. And we have to just think about why that is. The big picture is that the models are so potent, they're so powerful already as they exist, that there's so much consumer usage and growth in consumer usage, but more importantly, the business demand for AI compute capacity is growing so fast that it's telling the key providers, which are Amazon, Google, and Microsoft, that they need to buy as many GPUs as they can. Every data center they're building right now is already committed for 3 years out. And that's because the models are so potent and powerful that their business customers are telling them, we think this is going to be such a productivity enhancer for us that we're willing to commit 3 years out for this capacity. The market isn't just the market for enterprise technology. The customers for Amazon, Microsoft, and Google that are buying this capacity believe that it will be a labor replacement. And that's why we're talking about these kinds of magnitudes. We start talking about trillions of dollars because we're not just replacing parts of the technology stack, the enterprise software stack. We're starting to talk about how this is going to impact the labor market, which is obviously in the tens of trillions. So that's how we got to these very large numbers, and that's why we're still growing these very large numbers.
Just the Journal again says NVIDIA is developing an enviable problem. So much cash coming in. The Journal says this is draining the cash flow of big tech because they're spending so heavily. But annual cash flow for NVIDIA has now topped $80 billion.
Yeah. So two things. One is they're taking the oxygen out of the room. It's not, they're growing the pie, but they're taking increasingly large parts of the pie, right? The cash flow for their customers is diminishing, and for their customers, it's diminishing as well. It's a lot of NVIDIA sucking the oxygen out of the room. Now, what do they do with that cash? Again, some of it they're going to buy back stock, but they also have an opportunity to invest in the ecosystem. That's what we saw with their announcement about an investment in Anthropic. They're already investing in OpenAI. They're investing in neo clouds, which are companies that are there to compete with their core customers. They just have too much cash. They run out of things to do with it.
The Journal, sorry, I keep going back to them, but they have been beating the drum that OpenAI and Anthropic need to produce massive cash flow themselves to support their own ambitious spending plans. Could that be a weak point in this whole circus, that these actual providers of AI technology aren't getting in enough cash to support their spending?
Yeah, so OpenAI and Anthropic themselves are driving a lot of the demand, but they're not necessary. The frontier model at Google is just as good or better at many of the things that OpenAI and Anthropic do. And if OpenAI and Anthropic can't raise capital fast enough, the frontier models will just be frontier models from Google and Microsoft and Meta and Amazon. Right now, OpenAI has the lead in chat. They have most of that market. Anthropic has the lead in enterprise coding models. which is why it makes sense for those big companies to continue to invest in them, which is what we're seeing. Microsoft and Amazon are continuing to invest in OpenAI and Anthropic. It's still worth it for them. Now, OpenAI and Anthropic are both losing tremendous amounts of money, especially OpenAI. But part of that is because OpenAI's scope is way, way too ambitious. OpenAI at some point will need to focus on what they're really good at, which is ChatGPT, and stop trying to become another mega cap by building their own chips and their own hardware and their own data centers. They don't have the capital to do that. They've caused a lot of the noise in the market. The reason there's been such a backlash around the AI trade is that OpenAI created unreasonable expectations from their commitments. They inflated some asset prices, including those of Oracle and CoreWeave and AMD and Broadcom. And as it became clear that OpenAI can't live up to all those expectations, many of those stocks got deflated. That's the reaction we've seen over the last few weeks. But realistically speaking, we don't need OpenAI for the AI ecosystem anymore. They had that big breakthrough with ChatGPT. They still have the biggest part of the chat market. But even if OpenAI was to go away tomorrow, we would still continue to move along the frontier of AI models.
Gil, always great talking to you. Thank you very much indeed.
Thank you.
Gil Luria, Head of Technology Research at D.A. Davidson. Coming up, seems incredible, but hunger, or at least food affordability, a growing problem in Canada. We'll be right back. Walmart has raised its annual forecast for the second time this year. It posted another strong quarter, and there was a surge in online sales. This is seen as a signal of confidence headed into the holiday season. We're joined by Jacob Aiken-Phillips, VP of Consumer and Retail Research at Melius Research. Jacob, thank you very much indeed for joining us. Last time I looked, Walmart was up about 3% in the pre-market. What is going right for the company?
Yeah, I mean, another strong quarter. Sales grew 6%, beating consensus. Operating income up 8%, excluding some of the non-core stuff with the PhonePe valuation. But I think it's really a testament to they're resonating across all income cohorts. The higher income, they've been gaining share for a while, and it's still doing really well. But even among the lower income, they're responding to the 7,400 rollbacks they're doing, really focusing on affordability of food and convenience and pushing across the entire organization from digital to in-store remodels, et cetera.
And interestingly, they're doing just fine in online sales. I guess they've long been legendary for their logistics, and that lends itself, it appears, to selling over the internet.
Yeah. So e-commerce up 20% basically across all markets. The immediacy-based orders doing really well, which helps to fund some of that because they're charging fees. Just overall very strong from advertising, same-day delivery, in-store pickup across the board.
Let's have a look at the stock maybe over the past 5 years. Would you be a buyer of Walmart now?
Yeah, I'm buy rated on the stock. I think that the market still doesn't fully realize the transition that they've made, investing in this technology, becoming almost another everything store for the consumer. And that's not just in the US, it's across the globe. They're really dialing in, incorporating the more cutting edge generative AI into their system, both internally, but also with the new OpenAI partnership externally. And it's really driving results and showing that value and convenience across the globe.
And it's interesting, the high income people are quite happy going there. I mean, you're not going to get as fancy prepared foods, I guess, as in a full service supermarket, but people are willing to forego that.
Well, I mean, I would say that Walmart has also made incredible strides in their prepared food, their organic produce business. They've invested in that heavily as well, but it's really more all-encompassing than that. Everyone's looking for value, and they're being more diligent in how they're spending, and Walmart is able to provide that. They're able to provide very good, wide-ranged assortment across electronics, food, clothing, just generally anything you could want. And then their marketplace even opens up the doors to more types of products that maybe you wouldn't find in store. So I don't think the higher income consumer is looking at Walmart as a place you don't want to shop. I think they're more and more realizing the benefits that they get by shopping there.
Walmart now plans to move its listing to the NASDAQ, and they're saying this is partly because of our technology-forward approach. Bit of a blow for the NYSE, one of the most prominent companies in America.
Yeah, I don't have that strong of an opinion on this. I wouldn't say it's a blow to the NYSE as more as a testament to the NASDAQ and the technology forward thinking that exemplifies what Walmart also believes in their operations.
I do follow Target, Jacob. I forgot to check.
Yes, yes, I do. I'm hold rated on Target.
Why is that? Why has Target stumbled, relatively speaking?
Target is in a difficult spot in that they're competing essentially against Walmart and Amazon. And Walmart and Amazon have a huge assortment and they can provide the lowest prices. And Target has to differentiate themselves on different fronts. And some of that is just the coolness factor. They have their own like collaborations and Target specific stuff, which they called out a lot on the call. Over 10,000 items this holiday season are going to be Target exclusives. But I think that the real question is, can this new cycle of reinvestment in their stores, remodels, newer, bigger stores, and just continuing to improve on the digital front, will that be enough to drive traffic when Walmart and Amazon just continue to steal share across retail?
It's interesting. Yeah, we're looking at a scorecard there over 1 year. Walmart obviously doing much better. Here's a thing I just noticed from Bloomberg coverage in terms of Walmart moving up market. You can buy pre-owned Chanel bags online at Walmart. Yeah. Two names you would not think would go together, Chanel and Walmart.
Yeah, I mean, I would say that the consumer is a lot more willing to accept some of these higher end items or perceived higher end items than the vendors are. It's more on the vendor front, and they're being more hesitant to sell through Walmart. But with the marketplace, you can have third-party sellers, just like these Chanel bags, or even some maybe entry-level points for higher tier brands. So it's definitely a perception shift, but the consumer's further along in that shift than the vendors are, and I expect that to continue to happen.
Thank you very much, Jacob. I really appreciate it. Jacob Aiken-Phillips, VP of Consumer and Retail Research at Melius Research. Up next, food affordability is worrying Canadians. It's a top concern. We'll be right back. A new report indicates that food affordability and choosing local products are top concerns for Canadians. Let's get more from CTV's Scott Hurst. Scott, thanks for joining us. It seems pretty shocking, doesn't it? Food insecurity in this country reaching a record high.
Hey, good morning, Andrew. What do Canadians value most right now when it comes to putting food on the table, when it comes to feeding their families? Affordability. That tops nutritional concerns, and that tops just general taste with what you're planning to buy, as food continues to dominate household financial concerns across Canada, proving that managing budgets amid food inflation is showing the cost pressures continuing to impact Canadian families, with trips to the grocery store already eating away at tight budgets, with the average household food spending increased slightly in fall report from Dalhousie University. And most of that rise came from spending on groceries, suggesting Canadians are prioritizing eating at home to help manage the costs. Although another stark reminder of the affordability crisis comes down to food insecurity, with this report released just this morning showing that is now topping 25%, a quarter of respondents, showing many Canadians are still in a very tough spot, more and more not knowing where their next meal might come from, Andrew, or if they can afford it, of course, after all the other bills are paid.
And what does it say about the importance of getting food locally?
Yeah, there's one bright spot in this report, and that is the renewed enthusiasm for Canadian-made products. If there's one thing that is rivaling affordability, according to the report, that is trust and transparency. And Canadians are seeing that more and more in local products. A majority of respondents, some 52%, are saying that they now always or often choose local food over other options, supporting farmers, supporting domestic producers. And that is something that is shining brightly in this report, as there is, of course, so much concern about affordability. But when it comes to trust and when it comes to transparency, Canadians are turning to Canadian-made, turning to local products, Andrew.
And just on the food affordability front, could there be any relief in the near future?
Well, Canadians, according to the report, are expecting food prices to continue to rise next year, though fewer anticipate extreme increases. So maybe not that sticker shock that we have seen over the past couple of years when going down the grocery aisle, signaling potentially cautious optimism that food costs may at least somewhat stabilize, Andrew, in 2026.
Scott, thank you very much indeed.
Thanks, Andrew.
Scott Hurst, our colleague at CTV News. We are heading to the opening bells, but let's have a quick look at the markets. We did see relief over the NVIDIA numbers. That stock, as I said, moving up about 5% in the pre-market, and it looks like we are going to get a higher open on Wall Street today. So the S&P, it looks set, is going to open at just over 6,760. And the question is, can the market recover some of its losses over the past week or so? Wall Street Journal actually saying today that for the first time, it used a program called AlphaSeek to check this out. For the first time, an NVIDIA executive referred to a bubble, an AI bubble, using the B word. Apparently, Jensen Huang, the CEO, said there had been fears over an AI bubble, but then proceeded to say his company's numbers discount that. The S&P is still down a little bit from its record high on October 28th of just under 6,900, but not far to go. And let's have a quick look at a one-year chart for the TSX Composite and just track how far it is off its record. It is still down from 30,827 on November 12th. We'll be right back. There you have it, the opening bells at the NASDAQ. Central Bank Company is doing the honors. In New York, it's Viking Acquisition Corporation. It's time for the first 50. We'll check in on the markets. We did see U.S. futures pointing up in the pre-market, and there you have it. The TSX and the big U.S. benchmarks pointing higher in early trading. Markets generally encouraged by the strong numbers from NVIDIA. It wasn't a blowout quarter, but the projection seen as bullish. It was a strong quarter, but as Gil Luria reminded us, there wasn't a massive beat relative to expectations. Let's have a look at MDA Space, the Canadian provider of satellites and satellite technology. Actually, yesterday, the federal government said it's boosting its investment in European Space Agency programs by $500 million. This is a massive increase, about tenfold, according to Desjardins. It'll be spent over a period of up to 5 years. And Desjardins saying this should help to expand opportunities for Canadian firms such as MDA by providing a much larger customer base. And let's have a look at Celestica, because, of course, they are in many ways a proxy for NVIDIA. They have won so much business in supplying advanced assemblies of data center and AI equipment, and that stock, as you might expect, up 5% amid this morning's optimism over AI. And let's have a quick look at Stella-Jones. They make utility poles, railroad sleepers, and or railroad ties. The company has its investor day today. It actually began at 9 a.m. They came out with a new earnings per share growth target of above 10% compounded over 3 years, 2026 to 2028. And again, Desjardins says that's above consensus that had called for growth of only about 4% annually in EPS. So it looks like the street likes that projection from Stella Jones. NVIDIA, drum roll, let's see how it's doing. And NVIDIA, just to give you a perspective, got to a record high. I'm not sure if we have the updated actual move in the stock, but we're showing a price of $186 there. There we have it, sorry, 196 right now, up 5%. The record for NVIDIA was $212 at the end of October. So it's still down a little bit from that all-time high. And Walmart just burgeoning in online sales and interestingly moving to the NASDAQ shortly, saying this will reflect its technology focus. Coming up after the break, we are going to break down those latest results from NVIDIA, and we'll check out some other U.S. market movers. NVIDIA shares up in early trading. The results and the projections easing investor concerns about possible AI bubble. Let's get more from Christine Tan, Portfolio Manager at SLGI Asset Management. Christine, thanks very much for joining us. Looks like there is a sigh of relief here at the latest commentary from NVIDIA.
Good morning, Andy. Yeah, I think it's fair to say that there was some nervousness heading into earnings yesterday, and also there's been a little bit more of a noise around whether AI overall is a bubble, and our view is a bit more nuanced than just an all or nothing. NVIDIA, certainly with their numbers and the commentary from Jensen Huang, was quite reassuring. He spoke about strong demand for Blackwell, but more importantly, he really emphasized that they've been managing the supply chain for Blackwell very well. If you recall, a few quarters ago, there was sort of some noise around, how quick that ramp up in production was going to be. So it's both sides. I think that's sort of reassuring the market today. And he also highlighted what a good job a lot of the partners or the other players in his supply chain have been doing. So TSMC, SK Hynix. And so I think that's why you're seeing such a response to not just NVIDIA itself, but also the other companies that are within its, if you call it supply chain or value chain.
Sorry, what were the companies that you mentioned there, Christine? Give us one or two of them.
Yeah, he mentioned SK Hynix, he mentioned TSMC, there were a few others that those are partners that NVIDIA works with.
Right, and maybe we could have a quick look at AMD in a second, because of course they are seen as a potential rival in the high-end AI chip space, and this may be good news for them too if demand remains strong.
It really, NVIDIA remains the leader in terms of the most advanced, but theoretically, you're right. As the demand broadens out, you're going to have applications that don't necessarily need the most advanced, and AMD certainly could benefit from that, being an emerging player or a secondary player.
It sounds like, though, you and your team, you're not fully sold on AI. You're not going hell for leather into these stocks.
So our team ourselves, we don't select the stocks for the portfolios. We hire managers to do it for us. However, when you look at our underlying equity managers, your assessment would be correct. So they do believe that the capital spending and the emergence of AI and the need for more compute, and we're still in kind of the early stages of figuring out how to monetize it. Whether it's agentic AI or some of these larger language models and inference computing, et cetera. So they do believe in the overall technology. And there are certain core companies within it that are real players with strong cash flows and good balance sheets and a very strong competitive moat around its business model. I think where there's a bit more caution is around some of the smaller players or perhaps some of the more specialized players, where there tends to be a bit more excitement because they are so specialized and valuations can get a little bit extended. So Overall theme of AI, believe in it, just cautious around valuations and making sure that you're sort of positioning in where there's substance.
The TSX, you guys or your team reckon that the TSX was cheap relative to US stocks at the start of this year, but the discount has narrowed somewhat.
Correct. So TSX is still trading at a lower valuation, around 16 times forward consensus, versus the S&P at about 22 times forward consensus. Having said that, S&P typically trades at a higher valuations because there's more tech and higher ROE businesses. Canada, we do have more cyclical sectors like energy and mining. So at 16 times, kind of in line with historical valuations, coming into 2025, the TSX was inexpensive relative to itself. So our view is we are still slightly bullish actually on equities, both TSX and the S&P 500. We are aware that valuations are fair for the TSX and a little bit extended for the S&P. So our expectations for the rest of the year is kind of muted returns, maybe low single digits, maybe mid single digits at best. Now that's with the caveat that, you know, earnings have been quite resilient on both sides of the border. That's also specific to Canada. We are watching the trade picture quite closely. So we don't anticipate any significant developments ahead of the renegotiations of USMCA, which is due to happen by mid-2026. So our base case is for the rest of the year. You'll hear headlines every now and then, and certainly we've been seeing Prime Minister Carney really focus on forming new trade partnerships and trade relationships with other countries around the world, which we view as a positive in terms of just diversifying our economy. But yeah, we do think it's not as expensive, but again, it's not overvalued yet. So we expect the TSX to continue to benefit from relatively resilient commodity prices, and also the financial industries, you know, stabilizing in terms of whether it's NPLs sort of moderating. We recognize that the housing market, there are still pockets of concern, so we're watching that very closely. And we are a little cautious on some of the more consumer discretionary facing companies and names because, you know, as we've seen for several quarters now, the Bank of Canada's Consumer Expectations Survey has been showing that Canadians are feeling stretched, elevated cost of living, not quite seeing their wages catch up with that. Now, on top of that, there's a little bit of uncertainty around the job prospects as well as a result of the trade concerns.
What about healthcare stocks in the United States? They've long been seen as a reliable core for a portfolio. The health insurers have had a fairly rough year.
Yeah, so we have a proprietary U.S. sector rotation model that we use. It's part of our allocation within the U.S. equity segment of our solutions, our portfolio. And for November, the model actually allocates to healthcare and communication services. So it's interesting that you bring up healthcare. You're right. So healthcare is sort of split out into, you've got your pharma companies and then you've got your insurers and your benefit managers. And there's been a lot of noise around coverage and what that could mean. So that certainly has weighed on certain parts of the healthcare sector. Recently, there has been some positive developments on the for some of the players in the pharma industry. So you're starting to see a little bit more of a positive tone in healthcare that's showing up. And traditionally, it has been a defensive sector, but we have to always be cautious that there is regulatory risk around certain players and certain subsegments of the healthcare industry.
Christine, thank you very much indeed.
Thank you.
Christine Tan, Portfolio Manager at SLGI Asset Management. Yesterday on Market Call, we were joined by Tim Regan, Managing Director at King West and Company. He was covering North American large caps. His top picks were Strathcona, the energy producer, Quebecor, and Blackstone. Today on the show, it's David Burrows, President and Chief Investment Strategist at Barometer Capital Management. And he's taking your questions on North American large caps. Up next, apparently the federal and Alberta governments are just days away from reaching a deal on the future of Alberta's energy sector. That's ahead. Prime Minister has touched down in the United Arab Emirates, the first of two stops on his nearly week-long foreign trip. It'll culminate with the G20 Leaders Summit in South Africa. CTV's Rachel Aiello is travelling with the Prime Minister and has the latest on his efforts to diversify Canada's economy in the face of that trade war with the US.
The Prime Minister has come to this Gulf nation to pitch Canada to wealthy investors and to advance trade talks, but he'll be doing so while navigating some delicate diplomatic discussions. Arriving in Abu Dhabi, the Prime Minister was greeted with a grand welcome. Over the next 2 days, Carney will have a series of meetings with top government and industry leaders to try and attract more capital to Canada. Potentially helping that happen, according to a senior government official who briefed reporters on the plane, the two countries will be signing a foreign investment protection agreement while Carney is here, a pact that's been in the works for nearly a decade. The Prime Minister also intends to launch trade talks with the UAE towards a new comprehensive economic partnership agreement that would make it easier to do business. Last year, Canada's two-way trade with the UAE was valued at more than $3 billion. But the federal government sees potential to expand energy, agriculture, and artificial intelligence partnerships. Carney's time in the UAE also comes as this country is pushing back hard on accusations it's fueling Sudan's war. The Canadian officials expect the Prime Minister to raise the issue along with a series of other security concerns. But that and other frank conversations the senior official said Carney is likely to have here are all going to be happening entirely behind closed doors, as the UAE government is restricting Canadian media access to the Prime Minister's bilateral meetings. Rachel Aiello, CTV News, Abu Dhabi.
Sources tell CTV News that the federal and Alberta governments are days away from reaching a memorandum of understanding on the future of Alberta's energy sector. Let's get more from CTV's Jeremy Sharon. Jeremy, thanks very much for giving us the time. What do we know so far about this potential, I guess you can call it, intention to strike a deal? An MOU is only an early stage.
Yeah, exactly, Andy. To your point, it would be the first stage of a potential deal, just an agreement that they are looking to get a deal done. But what we know is that sources tell us that the two sides are close, within days of agreeing to and signing a memorandum of understanding that would include focus on a couple of things. The first being a change, an adjustment to the industrial carbon price, which is currently frozen in Alberta. But that would make it or help for the Pathways project to be able to move forward and be financially viable. The other big thing that is being talked about is, of course, support for a pipeline to the northern coast of BC, a bitumen pipeline, which is exactly what Alberta Premier Danielle Smith has been pushing for, and that could include an exemption on the taker ban for that pipeline project. Of course, the taker ban has been a contentious issue when it comes to getting a pipeline project through to BC's northern coast, but the BC government has been adamant that taker ban needs to stay in place and completely opposes a pipeline to its northern coast. So that, of course, will be a big challenge. But what we know is that the federal government is perhaps days away. What we've been told by sources is it could be announced by end of week on that memorandum of understanding with Alberta that has been pushing adamantly for a bitumen pipeline to the northern coast of BC.
And it's going to be tricky. What about Alberta and BC? Could the two of those reach some kind of understanding?
That's going to be the biggest challenge. There's no question. The Alberta government has been very clear. This is an opportunity that would open access to new markets, Asian markets, specifically for exporting Canadian oil. And we know that this government has been clear it is looking to diversify its markets. So I think it's no surprise that the federal government is working closely with the Alberta government to maybe try and push this forward. The BC government is going to be the challenge here. David Eby and his government have been clear. They oppose a pipeline. They believe that there is no proponent. They believe that the taker ban is crucial and needs to stay in place. And fundamentally, are opposed to this project, to the potential of a pipeline to its northern coast. And so the biggest challenge will be in discussions between the federal government and the BC government and the Alberta government and the BC government to try and come to some kind of agreement. The Prime Minister has been clear in the past, Andy, that he would not move forward with any project in a province where the provincial government is not on board. Basically that he would not steamroll a premier to get a project done, because the premier, ultimately doesn't have legal authority to stop a project from happening. But the Prime Minister has been clear that he'll be looking for buy-in from the provinces involved. So that will be the single biggest challenge moving forward, is whether or not there is any wiggle room to be had in BC, and if not, how does this move forward, and how does the Prime Minister move forward? Because if he doesn't move forward with this agreement with Alberta, Premier Daniel Smith is going to be very upset. And if he does, Alberta's or BC's Premier David Eby is going to be upset. So there's a difficult situation that the Prime Minister is left to deal with here. And likely he's going to have to make a very difficult decision.
Thanks very much indeed. Surely it's a naughty one for the Prime Minister. Jeremy, really appreciate it. That's Jeremy Sharon, our colleague at CTV News. Coming up, we'll take a look at some early market movers on the TSX. Shopify is helping to lift our index amid a rally in tech stocks. We'll be right back. Let's check out some stocks on the move. We're joined by Bloomberg's breaking news editor, Lara Stanley. Lara, always great to talk to you. Thank you very much indeed. Bath and Body Works, can you update us there, please?
Shares are down this morning after the company said that they would cut its outlook and also implement a turnaround plan. They see about $250 million in cost savings from this turnaround plan in about 2 years. And they're really focusing on redefining and narrowing their focus on what the point of their business originally is. They had spent a lot of effort and money expanding into other areas such as men's care and grooming and hair care. And so really that took the brand a little too far. It was focusing on promotions, and that hurt returns. So really they're trying to, as I mentioned, focus more on their core business here. So this is also leading them to launch a branded store on Amazon. They're trying to address competition that way and also reach the consumer in a new way, really with this consumer focus under this turnaround plan. But that said, even despite the outlook cut, the quarter results were a little rough. The revenue missed, the profit missed, and they really blamed a weaker consumer backdrop, saying that shoppers are a lot more cautious amid job worries, changes in technology, AI, and tighter finances. So all of that sending shares down this morning.
And Verizon, what's the story there?
Speaking of job concerns, Verizon is cutting 13,000 jobs in what is said to be its biggest restructuring and job cuts ever. So this is due to, it could shrink its non-union workforce by about 20%. And this is also due to a turnaround plan that's under its new CEO. The CEO said, quote, they want to create a simpler, leaner, and scrappier business. Interesting word choice there. So the CEO said the cost structure right now has really limited their investment in customers, and that has to change. So they'll be cutting at all levels of the business. This will be impacting retail, customer service, even some senior executives in this very wide range of job cuts, which will be completed by the end of the year, we are told. So they're also working on restructuring their retail footprint as well, in addition to the job cuts. So they're reevaluating some of their properties and their office space, and they're going to convert 180 company-owned stores into franchises. But really, this follows a broader trend we're seeing right now of layoffs. We've had layoffs at Amazon, UPS, a lot of other companies. So we'll see how the effects play off broadly and for Verizon specifically.
Thank you very much, Lara. Always great hearing from you. Lara Stanley of Bloomberg. Let's check in on the stock market in Toronto, because we are seeing some high-profile stocks doing well today. There is the TSX, and it is higher. And here's one of the reasons. Let's put up a 10-year chart for Royal Bank of Canada, a flagship among Canadian stocks. And that one's, according to my screen, hitting a record high today. Royal Bank moving up less than 1%, but topping $209. So that always helps our market when you see Royal Bank doing well. I mentioned this before the break. Shopify is higher amid a rally in U.S. tech stocks following the reassuring projection from NVIDIA about rapid growth. We've got, I did see Aritzia doing well earlier. I'm not sure if it still is. Let's have a look at Suncor, though. There's Aritzia. It's trading. It's near a new record if it's not quite there yet. That stock has thrived. Let's have a quick look at Suncor, a 10-year, because that stock hitting its highest in at least a year. There's a one-year chart for Suncor. Investors falling back in love with that oil sands giant. Stella Jones, SJ, let's have another look here. They are having their investor day, and they did project growth over 3 years that exceeds analyst expectations. Cardinal Energy, CJ, is another of these hot energy stocks in Toronto. Investors happily buying in to the energy names despite a pretty lackluster oil price, still stuck at around $60. Whitecap Resources, WCP, also doing well lately and hitting its highest in at least a year. I'm just trying to check here if that is getting close to a record. No, you can see that it isn't. That stock still down, actually, from its level in 2014, according to my screen. Oh, no, I meant to say WCP, not CP. That's my weird diction. WCP Whitecap it's about $12 right now, but still down from 2014. Next, we are talking markets with Garrett Anderson of Tacita Capital. Welcome to the second hour of The Open. Let's check out the stories we're bringing you from the BNN Bloomberg newsroom. Canada and the United Arab Emirates have agreed to strengthen their economic partnership. That's after the Prime Minister met with officials in Abu Dhabi. Both countries are looking to cut tariffs, remove trade barriers, and expand market access for Canadian exporters. This trade understanding will support Canadian businesses in expanding into the UAE across a range of sectors, including engineering, construction, and aerospace. The U.S. ambassador to Canada says this country and the U.S. have a chance to reach an agreement to reduce tariffs. The ambassador, Pete Hoekstra, told a conference in Ottawa that talks will resume, but he's not sure when. U.S. President Donald Trump halted negotiations in October. That's after Ontario Premier Doug Ford ran an anti-tariff ad featuring footage of former U.S. President Ronald Reagan. Shares in Palo Alto Networks down about 2%. The software security company beat estimates on revenue and profit in its latest quarter, but investors seem to be focused on a decision to acquire an outfit called Chronosphere for $3 billion US. Some analysts note concerns about the company's core performance and the risk that comes from integrating multiple large acquisitions. TSX higher today, boosted by heavy hitters such as Royal Bank and Shopify. Let's have a look at the U.S. markets. Investors pleased with the projection of rapid growth from NVIDIA, even though its revenue has soared into the tens of billions. Wall Street Journal reckons NVIDIA is pocketing about $80 billion annually in cash flow right now. Let's have a look at oil. We did talk before the break about strength in a lot of these Canadian oil stocks, but oil not doing much of anything today, up less than 1%. Let's have a look at gold to see how it's faring. The prospect of the Federal Reserve holding off from interest rate cuts isn't great for bullion, but it is still above that $4,000 US mark. And finally, let's have a look at the Canadian dollar. It is slightly down today, but just very marginally. We've been talking a lot about NVIDIA, but let's get a bit more about Walmart. Walmart sales topping expectations, the company raising its forecast again and moving to the NASDAQ because it says it's such a tech-forward company now. Let's get more from Garnet Anderson, Head of Portfolio Manager at Tacita Capital. Great to see you.
Great to be here.
It's interesting about Walmart, isn't it? Moving to the NASDAQ.
Well, it is a little bit. I mean, it's the bellwether for U.S. consumer. Over 80% of its sales come from there. But it is going quite hard at the whole AI theme, if you will, from consumer-facing to employee-facing to supplier-facing to their own tech stack. So it's an interesting move, to your point, to going over to the NASDAQ. At the end of the day, I don't think it's a massive, yes, exchanges battle for listings. There's fees involved, so on and so forth.
Yeah.
For the end investor, I don't think it makes much of a difference, to be honest with you. It's already a behemoth. It's already in the benchmarks. So it's not like you're having something that's going to all of a sudden be added to a benchmark that's going to boost a bunch of index buying.
The NYSE must be annoyed, though, because they don't want to be seen as old-fashioned.
Well, well, that, or you see the battle that London's going through and trying to keep its own listings. And maybe we can look domestically and kind of go, we're going to have make sure that we keep as many listings as we have.
Yeah.
I mean, we're not a country, greatest country in the world, but we don't have the deepest stock market. And yes, we've got a lot of listings, but a lot are, on the venture exchange. When you take a look at our large caps, we certainly have some world beaters, but it's not like the States where you've just, you look right, left, and center, and they're just all over the place. So let's keep our listings here as well.
I'm not sure if you saw that story from the Globe's Niall McGee that the federal government is trying to twist Anglo American's arm to put their primary stock listing in Toronto.
If you want our minds, perhaps that's part of the quid pro quo.
Yeah.
And I don't blame it. And because you've had others that have, talked about moving their head office down to the States. And you just hate to see that slide further.
Yeah, but of course, that's what the Americans want. That's Trump's game here.
Oh, absolutely. It's about bringing back manufacturing, bringing back factories, bringing back services, tariff revenue. The whole kit and caboodle absolutely is about bringing that business back to States because they're saying we're the greatest consumer economy in the world, and we want more of that being local. And that's a multi-year rollout. But you are seeing where he is chalking up some wins.
Oh, yeah.
May not want to admit it, but some of that game plan is working out.
I mean, there are critics who say we've always been a branch plant economy. I mean, maybe it's inevitable with a gigantic neighbor.
Well, I think, obviously we're much more attuned. We were talking about this yesterday in the office. Nothing galvanizes a community or a country like having an enemy. And I'm putting rapidly around the enemy because they're not our enemy, they're an ally. But you need something to focus, a challenge to the thing. So yes, let's go and strike these deals with other countries. Let's get our employees, let's get our companies being more competitive, driving towards higher productivity, more investments made, not relying so on cheap labor, so on and so forth. Let's move up the food chain. Let's just not ship the oil, let's start to refine more of it. Let's go dig out the rare earths. This is a big technical challenge. But let's try to process them. Well, let's recognize, they're going to list out all these projects for the nation to march forward and improve our economy and make us more resilient. They're not all going to be successes. That's life. That's business. Fail fast, get in there, spend the money, and let's go. And let's hope we get 3/4 success rate.
Do we need a more risk-taking business culture in Canada? I mean, Canadian companies reluctant to invest, it seems.
It's not part cultural. It's not a light switch you can just throw and wake up tomorrow and I'm going to be entrepreneurial. I'm going to be risk-taking.
Right.
But slowly but surely, coming all the way up from our education system to how we make it easier to lend to and start young companies, how we support them, how the professionals, be the accountants and lawyers, support that grassroots should bode well for us for 5 or 10 years. You and I have chatted before. We're probably in for some rough times. 2026, USMC renegotiation. we're going to be put to the wall a couple times. But 10 years from now, are we better for the challenges we're enduring today and expect to endure more over the next couple of years? I'm optimistic. I think that in 10 years, Canada will just be that much more of a world leader.
Yeah, necessity being the mother of invention, we might just have to. Yeah.
Right? And we have a tailwind. We're blessed with natural resources, highly educated citizenship. Let's make hay.
Talk to us, this is indirectly, well, fairly directly connected to NVIDIA. Celestica is a stock you continue to own.
Well, we do. We've owned it for a while. We're kind of quip. I mean, it's still a buy. It's got great momentum characteristics, and we're quantamental in nature. So we take a look at the numbers first, and then we kind of figure out if any of the story, dissuades you from taking that position. It is up so strong. It's up 230% this year. I mean, it's the proverbial Peter Lynch 10-bagger or the last little bit. So we have been having just risk management. You have to take a little bit off the top here and there. Having said that, we think it still remains well positioned in Canada. It's got a diversified business line. It is not a high margin business like NVIDIA is, but it certainly has grown its profitability. It's grown its profits. Its margins continue to improve. They're not stratospheric. And its valuation multiples have also improved. So it is a good company. It got tattered in the tariffs because they're global, and particularly over in Southeast Asia. They've got production plants over there, and they went, oh my goodness, what's going to happen on the tariffs there? They've come back from that, but it is a stock that's a little bit prone to sell-offs in the 20% range. Call that once a year. As most recent before this morning, I mean, it's rallied a little bit this morning. I think it's 3 or 4% up this morning. It was off 11%, so it wasn't quite down at a juicy buy rate, but it's certainly something that Canadian investors might not be getting. If they own the TS660, it's not a component of there. It's like 1.8% of the composite, so it's not like it's NVIDIA that's 8% to the S&P 500, where you already have it.
Yeah.
If you own SPY or whatever your S&P 500 index is. So it's not a bad little complement to the portfolio, but new buyers, I think, would want to be patient.
With Celestica, yeah,
Yes.
it's not screaming out at you now for new money.
No,
anyway.
no. When risk management trim, it's not a wholesale sale either. It's a good, solid company. But as an entry point, we're probably not there yet.
Just circling back to sovereignty, I'd love to get your... Do you think Carney will dare to buy a fighter jet other than the F-35? I mean, the Americans will be furious.
They oh goodness gracious, that's a fantastic and loaded question. I can say, it's not really to do with markets, really more to do as a view, right? The part I don't have is if you divide it and say I'm going to take half the Saabs and I'm going to take half the F-35s, what is incremental maintenance and management and training costs per year? I don't know if that becomes prohibitive.
Yeah.
If it's not prohibitive, it would seem to me that it's a solid strategy. So you've aligned with two ways. I mean, the F-35, by all accounts, it is the leader. But if you, I'll go another way. It struck me as strange that President Trump came out with the 51st state talk before every country got to go militarize more. You got to spend more. Now that's been a beaten drum, but he meant it this time, and we're reacting this time. I don't understand why it was like, well, sell you all the F-35s you want, and then start the banter about, well, maybe you become, the 51st state. It was kind of just bizarre, backward. Having said all that, I think there is a chance that they will have to diversify out, and if it's not in planes, it will be in other sources, via drones or whatever. The other thing too is we've got to. I mean, the Avro was back in the 50s. That's a long time ago. That knowledge base is gone.
Yeah.
In Canada, we've got Bombardier. That certainly has some of that knowledge, and other, associated companies like that. But if we can bring back jobs, bring back the education around there, so we become more self-sufficient. It's like part of the reason why I think Trump wants to bring back more manufacturing in the States. You come out of World War II, and everybody was able to go out and build the tool and dies, and that helps support their military complex. Well, those people have now retired. They're selling off their companies. They're winning away. So they looked at their own trade system and trade school system and went, we got to bring up the next generation. People are going to be able to build the things. You can design them, but you have to be able to build them. And we have to be able to do that in Canada.
It can take a generation or more to do that. Yeah, yeah.
You want a tree, plant it today.
Garnet, thanks very much. We covered a lot of ground there. We solved the world's problems.
Oh, we did. Excellent. Thank you.
Thank you, Garnet Anderson, Head of Portfolio Manager at Tacita Capital. Coming up, we're going to check out 3 plays in basic materials. On Hot Picks today, we are talking materials. Our guest has Albemarle as a top pick. He says this giant lithium producer should benefit from rising prices for the commodity. We're joined by Seth Goldstein. He's Senior Equity Analyst at Morningstar Research. Seth, thanks very much for coming on the show. And we have seen something of a bounce lately in these lithium names, and you see more upside for Albemarle?
I do. I value Albemarle at $200 a share. So we still think there's a lot of upside, despite the fact that the stock has seen a pretty large rally from its recent 52-week low. And the rally's been driven by rising lithium prices. So since about the middle of the year, since early July, we've seen lithium spot prices in Asia, the largest battery market, start to rise. And while we still think they have much further to go, the rise has been enough for Albemarle to start improving its results. So when they released their third quarter earnings, we saw the company did see lower lithium prices, but they had lower unit production costs, which drove profit growth, and they generated positive free cash flow. And that is a sign that Albemarle is a low-cost producer. We have a narrow moat rating on the name because of its low-cost lithium assets. And so we think they can get through the bottom. And as prices continue to rise, they'll be one of the largest beneficiary as we see lithium demand growing faster than supply over the next coming years.
Partly because of electric vehicles and I guess large-scale energy storage too.
It is. So we're seeing global EV sales continue to grow. And even though we expect that we'll see the U.S. EV sales fall next year as the tax credit expired in September, we do think globally we'll continue to see growth in key markets such as China and Europe. And so for lithium demand, it just matters that EV sales are growing globally. And then we're seeing the large utility scale energy storage batteries. These are being built to accompany solar and renewable projects. These are also being built in data centers to ensure grid reliability in new data centers. So here is a new case that's the fastest growing demand source for lithium. And as we've seen prices fall over the last few years, there's been a lot of supply cuts in response. And so now the market's going to move into balance due to the strong demand growth.
Your next idea, Nutrien, why they are going through a pretty aggressive restructuring actually right now, selling off some important assets. Is that part of your bull case on the stock?
It is. We value Nutrien at $70 for the U.S. shares. And so we see a good upside to the current levels. And we think Nutrien's management is running the business very well. We like to focus on free cash flow generation. We like to move to divest retail assets and smaller businesses, smaller fertilizer mines in South America, where they tried to expand in that market to take advantage of demand growth from farmers, but they realized the returns weren't quite there. It wasn't as good of an investment as their expansions and their North American assets, both on the retail and fertilizer side. And so we credit management with being willing to walk away, divest assets, and put the cash flow either to share repurchases or to better investment projects in North America. So the company is underway divesting some South American assets. They're also reviewing their phosphate business, which has been one of the smallest businesses for Nutrien since the company was created years ago. But we do think that this business is less profitable, likely generates less free cash flow. And if they sell the business, they could use the proceeds elsewhere. So we like the move to at least review the future of the business.
It's interesting. The Globe and Mail reports today that Nutrien has selected a port in Washington state for a new export terminal worth up to $1 billion. Of course, that would be a blow to our government, which is trying to get infrastructure built in this country. We're trying to check whether Nutrien has actually done that or made an announcement. Finally, Qunity, and I hope I've said that right? I never can remember the pronunciation, but they make materials for the semiconductor industry.
That's right. So Qnity, and you did pronounce it right, was recently spun off of DuPont, and it's DuPont's semiconductor and electronics business. 2/3 of what they make are the chemicals and materials that you need to make semiconductors, and the rest is the chemicals and materials that you need for printed circuit boards to ensure things like our phones can connect to the internet, or in a data center that the devices throughout the center can have high connectivity so the data center functions really well. So these are very crucial materials. As we see globally, more data centers will be built out, phones will need increased connectivity over time, and we're going to see the need for more semiconductors and more powerful semiconductors. So we value Qnity at about $100 a share, so we see good upside to the name, and we think they are one of the leaders in these advanced materials and chemistries needed to support this demand growth, to support more smaller, more powerful chips, which do require better chemicals and better materials over time. So we think this is a good long-term growth, a good way to invest in rising semiconductor demand and increased connectivity over the years.
It is amazing the level of technology that the chip people are reaching right now, the tiny scales that they're operating at.
It really is. And TSMC is going to come out with transistors that are just 2 nanometers large, which continues to get smaller and smaller and more powerful over time, which makes our phones work better, allow us to do more as consumers. We ultimately get the benefit, even if we will be paying up for our future phones. But for a company like Qnity, they are working hand in hand with companies like TSMC and Intel to ensure that they can produce these chips and do so at good yields.
A nanometer being 1/1000th of a meter. It's just... it's mind-blowing what they're doing, yeah. Seth, we'd better leave it there. Seth Goldstein joining us. Thank you very much. Senior Equity Analyst at Morningstar Research. Coming up, we'll tell you about an ETF you might want to consider for periods of high inflation. We'll be right back. This is an intriguing ETF. It's designed to help protect you from inflation. It trades in the United States. It's called the Horizon Kinetics Inflation Beneficiaries ETF. Not a short name. The idea here is to invest in companies that are expected to benefit either directly or indirectly from rising prices. The geographic exposure, about half of it is in the United States. More than a third, though, in Canada, and a small weighting in Singapore. Now, let's have a look at some of the top holdings here, because there are some well-known Canadian names. Wheaton is a big weighting, around 8%. And then there's an intriguing company here called Landbridge, and they say we actively manage our land and resources to encourage energy and industrial development. So it looks like it's a company that holds land. It has, it says we have surface positions in the Permian, and then we develop it to support energy. That includes the oil and gas industry, but they're also interested in working with data centers, it appears, as well. Okay, so Landbridge, a big holder of valuable oil and gas land. Then Franco-Nevada and Wheaton, both gold plays, and gold traditionally is seen as a hedge against inflation. Of course, in the near term, it is paradoxical. If inflation comes back, that tends to push up interest rates, and that is seen as bad for gold in the short run. Then we got more energy, Prairie Sky, a royalty play. And then finally, we have a company called Waterbridge, and Waterbridge are involved in water management, including cleaning up water for the oil and gas sector. So those are 5 of the top holdings. I think, do we have a chart? I'm not sure if we've shown a chart yet. So you can see, over the past year, it certainly is up. And it's interesting to build a portfolio that will help you in times of inflation. Coming up, Palo Alto, the big player in computer security, is buying an AI company called Chronosphere for more than $3 billion US. Investors don't seem thrilled right now. Shares in Nvidia up about 4% after that company posted profit that topped estimates. Revenue surged 62% in the latest quarter, and the chip giant issued a strong sales forecast, pushing back on fears that the AI industry is in a bubble. The CEO, Jensen Huang, also signaled that the $500 billion revenue target set for coming quarters may be even bigger than anticipated. NVIDIA has faced growing fears in recent weeks about what the pessimists fear will be unsustainable spending on expensive AI equipment. Shares in Walmart trading higher, up about 6% after the retail giant boosted its full-year sales outlook. It beat profit estimates and revenue forecasts in its latest quarter. Walmart also saw growth in its e-commerce segment, and it's incorporating AI across its operations. It has teamed up with OpenAI so shoppers can buy products via ChatGPT. Northland Power, the renewable generator, is aiming to double operations, focus on core markets, and narrow its organization from 3 regional hubs to 2. And the company will focus on the Americas and an international hub. Northland says the shift is part of an updated strategic outlook through 2030, meant to simplify its structure and focus on resilience. North American markets higher right now, with tech stocks getting a boost from the optimistic, or let's say strong, NVIDIA outlook. And you can see the TSX trading comfortably above 30,600 right now. Let's get back to Palo Alto, the huge player in cybersecurity. It's buying an outfit called Chronosphere for about $3.3 billion US. Chronosphere is a New York-based company in AI. It helps customers summarize huge volumes of information and apparently provides insights that help reduce complexity and reduce costs. Investors, though, seem cool right now. Palo Alto stock under a bit of pressure. The company also reported its first quarter results. We're joined by Peter Levine, enterprise software researcher at Evercore ISI. Peter, thanks very much for giving us the time.
Great. No, thank you for having me.
Palo Alto down a bit today. Any particular reason, do you think?
They reported earnings last night, and it was their fiscal first quarter. So I think overall it was a healthy quarter. It wasn't great, it wasn't terrible, but it was in line to a healthy, well-executed quarter. They beat on the top line. I think the guide was, again, in line with expectations. Maybe the software services component was a bit lighter than most would have expected. But I would say they reiterated their free cash flow margins. You're still seeing a lot of leverage in the model. So overall, it was a healthy report, but maybe just high expectations were kind of going into the print.
What about this latest acquisition? Any acquisition, of course, involves integration risk or possible jack-in-the-boxes that turn up after you buy the company.
Right. Well, they have 2 large acquisitions right now on the table. CyberArk, which is the largest one for, call it 20-something, 22 or 23 billion. That's expected to close in their fiscal third quarter. That seems to be on track. They're still waiting approval for about 6 other or 8 other jurisdictions. And then the deal they announced last night, Chronosoft, which you were talking about earlier, I think that's a really interesting play. They're now kind of moving into the infrastructure side of security. And, this Chronosoft, they compete with Datadogs and Relics. But what they're now doing is taking, I think application, like what observability does, it ensures that applications and infrastructure is running properly, right? So it looks at application performance, infrastructure health, microservices, and what they're doing is blending that with their SIEM, which is essentially taking all this log and all this data, telemetry, and looking at threat detection, behavior analysis. So they're merging those 2 together to give security teams, I think, greater visibility. So I actually think it's a pretty a strategic acquisition. It's merging. You're basically incorporating a lot more data, and again, I think it empowers the security teams. The price they're paying, at a multiple was definitely rich, but I think there's definitely a lot of growth behind this asset. It's strategic in terms of the data it brings. So from my perspective, I think longer term, I think this is going to be proved to be a strategic acquisition. But again, the street, I think near term sees some of the execution risk, of course, with both of these deals coming into play.
Let's maybe have a look at a one-year chart for Palo Alto. It always feels like it's the IBM of the cybersecurity business. Corporate purchasers may feel safe. Oh, we're going with Palo Alto.
So Palo Alto is like the Microsoft for security. You don't get fired for buying Palo. It has incredible products. They've expanded their portfolio to include, I think, all the core areas I think CISOs and security buyers need. So they do have a great reputation. I think what they're doing now with securing AI and trying to be at the forefront of that, I think the best example is with CyberArk and identity and helping companies as you're seeing a lot of these companies now deploying AI within their enterprise, it needs to be secure. And a lot of that goes with identity, which is CyberArk still helps with that. So I think they're making the right investments to kind of get ahead of like the AI wave that I think we will be starting to see.
It's interesting, as you know, a lot of conventional software companies have seen pressure this year. People concerned AI will disrupt their business. Is there the same kind of concern for Palo Alto?
That's a great question. I mean, I get that's a debate going on for a while, but I think within security, it's still somewhat. There's secular trends within security that aren't present in other subsectors of software. So if you think about the threat landscape, the geopolitical environment, the attack vectors. I mean, and especially with AI, like hackers are getting that much more intuitive, that much more smarter, and they can deploy these attacks a lot quicker than they ever had before. So the threat environment's not getting easier. I think budgets around IT, and you've seen some pressure here this year, but the only area within software that's still continuing to get a budget increase is security. So I don't think any CEO or any board is looking to cut back on cyber, but what they might be doing is trying to do more with less. And I think AI, autonomous agents allow security teams to do more with less when it comes to like your security operations center. You could parse through these logs, in milliseconds versus having, a human or two going through this, and maybe it takes them all day. So there's definitely a lot of efficiency gains that I think security companies or organizations can use internally. And for Palo, I think it's beneficial because there is still this labor arbitrage within security. There's a shortage of, I think, skilled labor within security. A lot of CISOs and security teams within enterprises, they struggle to find the right people to do this work. And I think Palo and every other security vendor, CrowdStrike and Zscaler and others, I think they're building the right AI tools to kind of plug the efficiency gains that I think a lot of teams need internally. So I'm bullish on security, bullish on the acquisitions that I think Palo is trying to kind of build. And again, they've been successful in the past with some of these, I would call it larger acquisitions they've done, and it's proven to be successful.
Are they a big investor in hardware? Do they run their own their own servers like the hyperscalers do? Or sorry, I should have said a big investor in equipment, in data centers, AI, actual hardware.
So they do. I think they do partner with like GCPs, and I think it's GCP, AWS. So they do leverage the hyperscalers. For Palo, they sell firewalls. I mean, that was their, that's how they got into security. That's their legacy business is firewalls. And I don't think firewalls are going away, but they just introduced, I think, their next gen firewalls. So from a hardware perspective, they still sell firewalls. Highly regulated industries still need firewalls. There's a refresh going on today, but with Palo, I think what's also strategic is they also have SASE, which is cloud networking, which is becoming the next trend within cloud networking. So there's a hybrid approach that they offer customers that a lot of competitors don't have. So from a hardware perspective, they sell hardware. That was the upside to the quarter. They had a better product quarter this in their fiscal 1Q, which drove most of the upside. But to your earlier point, they leveraged the hyperscalers when it comes to data centers.
Peter, thank you very much indeed. Peter Levine, enterprise software researcher at Evercore ISI. After the break, we are going to put the world's biggest retailer in focus. Sales at Walmart still rising, and the company is gaining market share. Walmart is raising its forecast for the year. It topped earnings expectations in its latest quarter, but the company is also warning that prices will have to rise. We are joined by BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, a strong third quarter and also a lot of news coming with this latest report from Walmart. We'll dig into all of it, but just to go through some of the numbers very quickly off the top, net sales expected to rise 4.8% to 5.1%. Revenue was up by 6% from a year earlier. That's $179.5 billion. That's above the $177 billion that was expected. Same-store sales were up. Foot traffic was also up. So looking pretty good for Walmart, but they did warn of higher costs coming in the future. So far, and it's because of mostly tariffs. So far, Walmart has been absorbing the costs of the tariffs for the most part and working with suppliers to try to keep costs down, sourcing from elsewhere when they need to. But costs are going to go up. That's according to the CEO of Walmart saying that, as inventory starts to run out, and most of that inventory was before those tariffs took place, now Walmart is replenishing inventory. And of course, that has an impact when it comes to the tariffs. And as we see with so many companies, you can only absorb the cost of the tariff so much. We've heard from so many different people within big companies saying we have been doing that, but not sure if that can continue in the long run.
And it's incredible how they are so huge in e-commerce now.
Yes. So that's the other big news that's really making news this morning. Big in e-commerce. Walmart is transferring the listing of its stock to the NASDAQ. This is big. I don't think this is something you see all the time, right? The New York Stock Exchange maybe not too happy about that. Depends on what analyst you talk to. I know you spoke with one earlier this morning who said this isn't that big of a deal, but this is
for investors. But
for investors, for a company to really make that move, it really shows a shift when it comes to their focus in the long run. As you say, a focus on e-commerce, really trying to ramp that up. Of course, when it comes to sales, for the most part, when we think of Walmart, right, you think of like the great value that that brand, and also just great value in general. Walmart generally used to have lower prices, but now they're really trying to incorporate different clientele, people with different incomes, with this e-commerce project, I guess you could say, that they're having in the long run. I know you mentioned this morning too, as an example, you can get now through an e-commerce third-party buyer, you can get, like, for example, pre-owned Chanel bags on Walmart.
On Walmart.
Something you didn't expect to see, maybe. And then also Walmart, another company that's, of course, ramping up its AI, partnering with ChatGPT. We've seen other companies, I believe Shopify did this as well. So you can basically go through ChatGPT, shop through ChatGPT on Walmart to purchase products through Walmart. So that's just another way we're seeing Walmart really start to ramp up its e-commerce, its online, really shifting to tech focus in the future.
And they're really getting in Amazon's grill here with the marketplace. they're saying to third-party sellers, come and list.
Exactly. Maybe not something you expected to see. And also, like, people can still go to Walmart and get what you used to get, right? Grocery business still accounts for about 60% of sales in the U.S., but there's just other opportunities now.
Lindsay, thanks very much. Lindsay Biscaya. Coming up, we're going to hear from a personal finance expert on a new report that highlights how different generations are financially preparing for retirement. That's ahead. So Manulife's out with a report, and it provides insights on preparation for a 100-year lifespan and a better 40-year retirement. So some big numbers here, but we are living for a long time. Let's get more from Julie Sabaris, Head of Wealth Planning and Practice Management at Manulife Wealth. It is incredible, isn't it? You could be in retirement for longer than you were working.
Absolutely, because our working age tends to be around 35, 40 years. And so if you're living for 40 years after that, that is essentially as long as your working years. And so not only is it the financial side of things, but we really also need to be thinking about the qualitative side of things. So what is your identity in retirement? What is your purpose? What are your social connections? Sometimes we see certain professions, a lot of their identity is wrapped up in that profession. And once you retire from that profession, now who are you and what is your new identity? So it's the financial and sort of the qualitative side of things too that we need to be looking at for that 40-year time horizon.
Some of your research has indicated as well that a lot of people left the workforce earlier than they had intended.
Absolutely, 44%, we saw that. And so that was a really interesting number. And the reason for that can be a variety of things, but the top things that we did see there were things like illness, caregiving, as well as job loss. And so when we're doing retirement planning, it's really important to look at those what-if scenarios. We often do our retirement plan thinking very aspirational. What do we want our retirement to look like? We're living to life expectancy. We're living in our home. We're healthy and we're mobile. And that's great for our retirement plan. But we also now need to say, what if? What if inflation is higher? What if there's an impact to my health or mobility? What if I can no longer live in my home? What if expenses rise? And then we need to stress test that plan. And when it comes to things like illness, which was one of the top reasons, maybe we look at things such as disability or critical illness insurance to provide a little bit of that income replacement so that if you do experience that illness, you don't need to tap into your retirement savings, hopefully, to bridge that gap. Because we know that if you retire a little bit earlier, chances are you're going to have to reduce your retirement income expectations in order to make that happen.
Right. So Gen Z, you're finding, are the most worried here or feel the least secure?
So, we really saw about half of individuals not feeling that secure. But what we saw with Gen Z, no surprise based on where they're at in their sort of life cycle, is that number one for them is really just sort of that, those day-to-day expenses and then saving for a home. Retirement's a little lower for them. But consistently from sort of millennial, Gen X, and baby boomer, saving for retirement is the number one thing that they're focused on. And, some sort of in better position than others. What was a little surprising to me is that what we saw with the Gen Xers, so this is going to be your individuals who are 44 to 58, about 1/3 of them have less than $50,000 saved for retirement. So
less than 50.
Less than 50,000, 1/3 of them. So again, this is the age group of 44 to 57. Some of these are really on that cusp of retirement and close to that age where we were seeing that people were retiring early. So they're probably not on track to retirement if they have less than $50,000 saved.
That's interesting. I suppose they are some of them are into their peak accumulation years, but less than 50,000 is not a lot.
Exactly. You're really going to have to pick up the pace. And if you're not on track, we really sort of look at the different levers that we can pull. So do you want to reduce your retirement income goal? Do you want to save more? Or do you want to push out your retirement age? But those people that were forced to retire early, there's only one lever they can pull, which is reducing your retirement age or retirement income goal. You can't push it out and you can't save more at that point in time. So you really want to be taking a look at that retirement plan and again, testing it for those what if scenarios. What if things don't go according to plan, which we know in life, not everything goes according to plan.
What about the boomers? Can you generalize about them?
I was actually really surprised to see the amount that they were concerned about debt. It was quite consistent with the other generations, which is around half. Because generally in financial planning, we don't want people to be going into retirement with debt. We don't want them to be going into retirement, ideally, with a mortgage. And so just seeing their concern around debt was quite surprising to me. And this is also the generation that's done quite well in real estate and able to build equity in their homes. So that part was surprising to me.
Julie, thank you very much indeed.
Thank you.
Julie Sabaris is with Manulife. She is head of wealth planning and practice management. Always great hearing from you, Julie. I love this story as well. Increasingly, Las Vegas and Wall Street are colliding in what Bloomberg calls a prediction market gold rush. We are joined by Bloomberg finance reporter Catherine Doherty. Catherine, what a great story you and your colleagues have written here. Just remind us what prediction markets are. We know about Kalshi and other players, but remind us what they are.
So you've probably heard of Kalshi and Polymarket. These are two of the biggest players that are offering prediction markets. In the simplest terms, it is a binary yes or no. You're betting on an outcome. Let's say it's an outcome of a sporting event. Will the New England Patriots win against the New York Giants on Sunday? Yes or no. You can take either side of that bet. This is meant to be an entry point for new participants to a marketplace that they otherwise might not have come to. If you think about traditional asset classes like options, futures trading, they have a very similar mechanism in that you are betting on a future outcome, but it is a little bit, it's structured in a different way that is in many ways what these firms like Kalshi and Polymarket are touting is the accessibility and this audience that they are looking to reach, which is much wider than just the traditional institutional financial firms that we think about.
And this is great. So the head of Intercontinental Exchange in his 70s had a fancy lunch with the 27-year-old founder of Polymarket, the latter turning up in a T-shirt and a paper bag from a bakery. And subsequently, ICE said it was going to invest $2 billion in Polymarket. So Wall Street and these quasi-gambling entities are coming together.
So it's a part of a narrative that is one that keeps on developing every day. You see these institutional firms like ICE that owns the New York Stock Exchange. They are partnering with Polymarket. They're investing $2 billion into the firm, and there's many different things that the two firms are going to work on together. But again, I think the important thing to understand is what it gives both of these companies. For Polymarket, they are now going to have access, and their data is going to be streamed to institutional clients of ICE and the New York Stock Exchange, and vice versa. ICE, with its institutional clients, will then have access to Polymarket's data, and they might even start trading these event contracts. So it's a mutual agreement between the two. We've also seen UFC fighting partnering with Polymarket, and the NHL League. This is a mostly a marketing, and they're working together to develop these contracts with both Kalshi and Polymarket, and we expect to see more sports leagues coming forward with future deals.
And is the SEC making any noises here about regulating these prediction markets?
So these prediction market players are regulated by the CFTC, very similar to options and futures markets, and they have gone into and there is an entire other narrative to go down in terms of Kalshi and Polymarket both looking to enter into this space. Polymarket has not yet gone live in the U.S., but Kalshi is. It is a regulated venue, but it took a long time for them to get there, and they explicitly wanted to go down the route of being regulated before they officially launched.
It seems like the world is going gambling mad. Incredible. You know, you watch TV and it's endless ads for sports betting, et cetera, et cetera. Great story, Catherine. Thank you very much indeed. Catherine Doherty joining us there. She, of course, is a Bloomberg finance reporter. Thank you very much indeed for watching The Open. Morning Markets is up next. And it is interesting. We're hearing online gambling causing severe addiction problems, especially among some young men. On that despondent note, thanks for watching the show. Morning Markets coming your way.